Okay, well, hi everyone. Thank you all for joining. I personally am really looking forward to today's session. This is a little different from normal BC Wood programming. However, today is a free session hosted by BC Wood associate member Greenspan Adjusters internationally. Specifically today, we have Rebecca Holloway and our speaker, Kenneth Crown here. So a bit of background about the company. Greenspan represents policyholders who have suffered major property damage, such as fires and floods. Their role is to ensure policyholders are indemnified when they have a first-party property claim, leveling the playing field to ensure they optimize all available coverages under their policy. So, with that out of the way, I'm going to pass the mic over to you, Ken.
Thank you. Good day to everyone. Thank you, Kit, for allowing us to present here. Just a quick background on my role with the company. I've been with the company since 1985. We are the largest public adjusting firm in the Western United States. We have offices throughout the West Coast, California, Nevada, Utah, Washington, Oregon, Alaska, Hawaii, and we've now recently opened up in British Columbia. Prior to opening in British Columbia, we would get a lot of phone calls through our Seattle office of insureds having issues with claims, questions with claims. And about 3 years ago, we decided to look into getting licensed in British Columbia. Public adjusters in general, we are licensed to handle first-party property claims only, and no different than having to have licenses in all the states that we practice business in. We also had to secure a license in British Columbia, and obviously COVID took a toll, but we are handling business there. We're hoping to expand our presence in British Columbia. And part of what we were wanting to do is to let people not just know about our services, but to educate people when they do fire loss as to occurs, and more importantly, making sure they've got the right coverage in place. And that's what the gist of our webinar will be, is talking about the coverages that are out there so that you as business owners will make sure you've got the right coverage in place. God forbid your business suffers a disaster or major fire loss. Next slide, please. So obviously, I'm waiting for the slide to change. Okay, that's the previous, next slide after that, please. Thanks. So obviously you want to make sure that your business has the right amount of insurance in place and that you've got insurance. Small Business Administration shows that 90% of most small businesses fail to reopen for a major loss. Sometimes it's because they don't have the right coverage in place. Sometimes because they're busy fighting with their insurance companies and not able to get their customers back. I'm going to talk right now about the basic components of a commercial policy. The first component is building coverage, that's sometimes called real property. The way building coverage works is to insure you for what it would cost to replace in like kind. So you want to make sure that your building coverages are up to date, current with what it would cost to replicate it. If it's an old Victorian building, obviously that's a lot more expensive to rebuild than just a standard concrete tilt-up building. If you have a building in which you have a tenant and the tenant may be a restaurant owner, many times, depending on the lease, the improvements and betterments that that restaurant owner makes, for example, a hood, a drop ceiling, flooring, painting, any permanent appliances that become affixed to the building, they may now become part of the building. And if your lease reads that they become part of the building immediately upon installation, then your insurance policy will provide coverage for the cost to replace all those improvements. So you obviously want to take a look at your lease if you're a building owner with the tenant. Business personal property covers all the personal property of the business. In Canada, they define it as equipment, stock, and property of every description. Property of every description would, of course, include supplies and furnishings. You want to make sure that your business personal property is properly covered and valued at today's costs, not what you paid for your piece of equipment 10 years ago and what it would cost brand new to replace. Loss of income or profits. Most commercial policies have it built into the policy, but some policies do not provide that coverage, and you want to make sure that you have it. Typically, if your policy doesn't have it and you want to secure coverage, they write an endorsement for it, and that's to pay for your loss of net income plus continuing expenses. That's key to have because you never know how long you're going to be shut down for and how it's going to impact your business. Next slide, please. I'm going to discuss the following coverages that are key for your business in making sure that you've got the right coverage in place. At the end of each slide or category, I'm more than happy to answer any specific questions. Rebecca will field them and she'll tell me what the questions are, and we can have open dialogue. Business income insurance, obviously, we talked about it earlier. It's typically insured either for an actual dollar amount or for a unlimited amount, but limited to 12 months, meaning there's no dollar limit for your business income coverage, but it will only insure you for up to 12 months. If you're a large manufacturer, you've got some really big buildings and it's going to take more than a year to rebuild, then obviously having insurance based on an actual loss sustained with a 12-month limitation is not the way to go, and you'd want to have a dollar amount. And typically, even if you think it's only going to take 12 months to rebuild the building, it always takes longer. The time frame to adjust the claim takes longer. If the building's to the ground, you'll have to get plans put together and get it approved. So we've had some clients where it takes 2 years to get a building rebuilt if it's a large building. So you're always better off having a dollar amount of coverage versus the 12-month limitation. Extended period of indemnification is an endorsement that provides you additional coverage above and beyond once you complete the repairs to the building, or if you're just a business to replace your equipment, damaged equipment and stock. And this is real important coverage to have because most people, when they open up their businesses, or even if it's a building and trying to find a tenant, they're not going to be able to get back to the level of income they were enjoying before the fire loss. If it's a restaurant, it may take several months to get back to the sales revenue they were generating before the fire. So that's why it's important to have this extended period of indemnity, because it pays for loss of income even after the building and the equipment and the stock is replaced. Extra expense coverage pays for any extra expenses you incur as a business owner to either try to resume operations or resume temporary operations. We'll talk a little more about that as well. Blanket coverage versus specific location. If you have multiple buildings with different dollar amounts of coverage, and you have a shortfall in coverage on one building that may burn down, it's good to have blanket coverage because that way you're not necessarily going to have that shortfall in coverage. And we'll provide an example of that later in the webinar. Valuation. Policies that are insured with replacement costs, you want to be careful to make sure it's true replacement cost versus functional replacement cost coverage. An example would be you have a large old Victorian building. Sometimes the carriers will write an endorsement called functional replacement costs. When you have a fire loss, the carrier is obligated for the cost to replace or repair the damages with like-kind materials. If you had a building that was 100 years old and had lath and plaster, finishes inside, clear heart, cedar, full dimensional framing, that's how we would measure it, because that's what you're entitled to collect for. A functional replacement cost endorsement eliminates the carrier being obligated to do that, and they'll only provide coverage based on functional equivalent finishes. For example, instead of collecting for the cost of lath and plaster, you would collect for the cost of drywall, which is typically 25–30% of the cost of plaster. Be aware that all policies of insurance only pay you actual cash value until you repair or replace. There are a few policies out there that offer full replacement costs up front, but typically in commercial, it's actual cash value until you make claim on a replacement cost basis. And actual cash value, by the way, is the cost to repair or replace less depreciation. Your commercial policies will have some language that provides coverage for a 30 or 60-day time frame for any newly acquired buildings that you as a business or building owner purchase, or for newly acquired equipment or business personal property from another business. Be aware, though, that it's limited to 30 or 60 days. The idea is for once you purchase any major pieces of equipment that you notify the carrier of your so doing. And by having this coverage built into the policy, in case you forget to call you do have this additional coverage, but it's limited usually to 30 or 60 days. Most policies will have a provision for seasonal increase endorsement. But again, you want to check with your broker and review your policy. What this provides coverage for is if you're a retail store and your inventories obviously go up over the Christmas holidays. For example, if you have a $500,000 limit of liability, but during Christmas, your inventories go up another 20 or 25%, and you suffer a loss, you would be able to collect above that $500,000 limit, typically up to 25%, as long as you've maintained on average the previous 12 months, $500,000 in value. Inflation guard, you want to make sure that your policy has that. It provides coverage for any increased construction costs on your building based on a national database for what construction costs increase each year. We'll talk a little more about that in the webinar. And then there's what's called bylaw coverage, which we'll talk about next in the slide. And that pays for, and in the States, they call it code and ordinance coverage or code upgrades. In Canada, it's considered bylaw coverage. A lot of times it's dependent on the local municipality or the province, but typically there'll be requirements. Sometimes it's based on the extent of damage. If the extent of damage is more than 50 or 75% of the assessed value of the property, they'll sometimes require the building be completely upgraded to code. Some of those code upgrades may be the foundation system, if it's a 30 or 40-year-old system that needs to be upgraded. It may be a requirement for sprinklers, snow loads for the framing, energy efficiency. Reminds me of an old claim that I handled many years back, Fresno Unified, and they had coverage of up to $1 million for code upgrades. And the insurance company was arguing with us because the insured's architect, the school district's architect, was saying that an elevator would be required. And all requirements for code upgrades in California go through the deputy state architect. And the insurance company felt that this was a hardship, and there's provisions in the deputy state architect guidelines that talk about hardship status and not having to comply with code upgrades that are required through DSA. And it was obviously the only hardship that was occurring was to the insurance company, because they were going to have to pay for this elevator, which was going to be about $1 million because of the impact on the finishes. I'll never forget going to the deputy state architect's office and sitting down with the insurance company adjuster and their cost consultant. And we were waiting for the deputy state architect. And when the double doors swung out and he came in pushing himself on a wheelchair, I kind of knew it was over. The insurance company consultant shook his head, and obviously the elevator was paid for and DSA required it to be installed. Next slide, please. We have a video for Trinity River Lumber Company. It was a large loss that we got retained on. Interesting enough, the carrier, I think, initially reserved the loss at about $6-7 million. We settled it for $20 million. And some of the next portion of the webinar is going to talk a little bit about their losses, about business income coverage and extra expense.
Why are you here today?
To support Trinity River Lumber and their success here and getting their mill back up.
Trinity River ran a successful two-shift operation until that eventful day of September 12, 2009, when we lost the mill due to a fire. With the help of Greenspan Company, we began the settlement with the insurance company. We want to thank Greenspan for their work in dealing with the insurance company and the settlement.
By the time we got on scene, the damage was already done, and we came in to kind of pick up the pieces and help guide them through the process of filing the claim and, you know, negotiating with the insurance company and bringing them up to speed with what is required.
The sawmill was started in approximately 1800 after the California gold rush in the area. The Trinity River sawmill is the staple of Weaverville. Without the Trinity River sawmill, the likelihood of Weaverville continuing is extremely doubtful. The coverage issues included not only the issue involving the per occurrence limit of liability in relationship to the statement of values, but also the protective safeguard endorsement.
How important is the mill to this community?
It's extremely important to Weaverville, and it's extremely important to all the communities around too.
Locals are pretty excited and helps give them more business around here from all the stores I've been going to. That's what they say, so I think it's pretty important.
With every client that we work for, I'm proud to say that there is a connection and there is a friendship forever.
Why are you here today?
There we are. Thank you, Rebecca. Just one thing to keep in mind, it was really important to get the mill back up and we helped them with their carrier, at least to get it partially up and running, finding alternative facilities for them, because they were the main employer of the town of Weaverville. I think they had 120 employees or more at the time that lived within the area. The next, by the way, are there any questions come up? Okay, good. All right. Business income or profits loss in Canada, they refer to business income policies as profit loss coverage. As I mentioned before, it's usually a dollar amount or an actual loss sustained limited to 12 months. It pays for your net income plus continuing expenses or gross revenues minus saved expenses. Obviously, if you're completely shut down, and expenditures that you won't be incurring that the carrier likes to take credit for. And the reversal is it's your net income loss plus continuing expenses. And if you're breaking even and you're thinking why bother to get an insurance policy for loss of income coverage. Well, just because you're breaking even and not making a profit doesn't mean you're not entitled to the continuing expenses that you would incur if you were completely shut down. So you always want to make sure you have business income coverage. When measuring for business income coverage, we look at what the gross revenues would have been had no loss occurred. And insurance companies will typically bring out what's called a forensic accountant to look through the paperwork of your business. They'll look at the previous 3 years and they'll do a projection. That's okay to do, except they're not taking into account what the business may have done had no loss occur. So we have our own in-house forensic accounting staff, and we look at the losses slightly different. We look at what would have occurred after the loss. Were you planning to introduce a new product line that would have increased revenues? Were you reducing overhead costs that would have generated higher profitability? So those are the things we want to learn about your business. And you always want to, of course, be ensuring to reflect your gross profit or your net income plus continuing expenses. What was an interesting claim I had was many years back, Fleur de Lis, it's a 4-star restaurant. The owner was at that time also chef to President Clinton. And people from all over the world would fly into this restaurant, fly into San Francisco, go to the restaurant. It was very well known. And at the time they had their loss, it was after 9/11 and it was after the market crashed. So their sales were flat and they weren't having any type of business income losses. And typically we, like I mentioned earlier, we like to look at the business and ask the right questions. And one of the questions I had asked is, Hubert, were you thinking of changing the menu, increasing the menu? And then his wife remembered that a few months prior to the loss, they were looking into changing the menu to a fixed price menu. And so then I inquired with Hubert to talk to his friendly competitors that have done fixed price menus and to find out what the increased revenues were that were generated after they switched over to a fixed price menu. And lo and behold, their revenues had increased 20 or 25%. At the time, Travelers was the carrier, and of course they were resisting that, but they did agree to my suggestion that once they opened up for business, if they were securing increased revenues, whether it be 15% or 25% over the 2 months following their reopening, would the carrier consider revising their calculations? And lo and behold, their revenues went up 28%, and the carrier did agree to revise their revenues. And instead of having a zero for business income, they collected over $1 million. So be aware that it's not measured based on typically what you were doing before. It's measured based partially on that, but what you would have secured had no loss occurred. Sometimes people don't have business income coverage. Does it mean you can't collect for some income losses? Many commercial policies will sometimes have an endorsement called a selling price endorsement on finished goods if you're a manufacturer or a winery, for example, and you've already produced the wine and it's been bottled and it suffers a loss. Typically, the wine policies insure its selling price. You may have stock that's already been sold but hasn't yet been delivered, that was getting ready to be sent out but was destroyed in a fire. Typically on commercial policies, stock sold but not yet delivered is value selling price, which of course is going to include your profitability and other overhead costs. Next slide, please. You can skip over the next one. Extra expense coverage is coverage to indemnify the insured for additional expenses that as a result of the covered peril. It pays for the cost to rent another facility. It pays for the cost, for example, trucking costs, which Trinity River incurred because they were having their product produced at one of their other facilities, but of course it was much further away. That was part of the extra expense claim. Any increased cost for renting temporary facilities. An advertising budget. Typically with a lot of our clients, we like to propose the right before they're getting ready to reopen to do a big advertising campaign so that people know they're back up and running, and to try to woo back any customers that may have been lost. By doing so, it actually reduces the potential cost the carrier may pay under the extended period of indemnification. It pays for improvements at temporary facilities. If you've got to upgrade a temporary building and incur a lot of improvements, it will pay for that as well. I had an interesting claim from a firestorm loss about 7-8 years ago, Adams Springs Golf Course. And the golf course, for the most part, didn't suffer major damage, but they did lose their clubhouse and some other outbuildings. And the policy that existed was a 12-month actual loss sustained policy. And the owner knew it would take at least 2 years before he was able to get his building rebuilt, and wasn't sure if he was going to rebuild or not. He wanted to stay open, but he just wasn't sure if he was going to go through the hassle of rebuilding. Plus, he had limited coverage on his building coverage. And so I proposed to him that we may be able to get the insurance company to go ahead under extra expense coverage and pay to bring in a modular building. We'll consider it temporary for now. It will allow you to generate some of the revenues that your clubhouse generated, allow your customers to come in for food, to sell goods. And eventually, after 12 months, you'll have a building that you'll be able to keep. And so we went ahead and did that. It wasn't just the cost of the building that the carrier paid for. The kitchen had to be installed and upgraded in the facility, the permanent foundation. And of course, it took a while for the carrier to eventually agree to this, but they waited till the winter time. So in order to get this temporary modular building put in, they actually had to lay a gravel road in order to deliver it. And that got paid for. And I think the overall cost was around $350,000. But the benefit was he now had a building that eventually became permanent and didn't have to use his building monies to replace it. So we get to be creative with extra expense coverage because it is really there to allow you to try to resume your operations. Interesting, the carrier never did ask for any salvage value or credit for the fact that this is a building that remained there. Next slide. Blanket versus stated limits. We discussed that earlier. This is an example of blanket coverage over 3 buildings. Let's assume for a moment you didn't have blanket coverage, it was stated limit, and building 1 gets destroyed in a fire. But to replace building 1 now, it's not going to be $1 million. It's going to be $1.5 million because you didn't have the right amount of insurance, or construction costs have gone up. And for whatever reason, the values hadn't been raised properly over the years. Well, with blanket limit, it's the combined stated amounts of all 3 buildings. And in this instance, you'd actually have up to $250,000 for the repairs to building 1. So you're always better off having blanket coverage if you can secure it, if you've got multiple buildings at a location, or sometimes if you're a landlord and you own multiple buildings at different addresses, you can all secure blanket coverage. And that same blanket coverage would also apply for your business personal property that were in the buildings. Sometimes policies are blanket, not just for the building coverage, but also for the business personal property coverage. Any questions, Rebecca?
Let's see. I don't know if this is the time for this, but someone says, when is the best time to bring you in?
Best time to bring us in, obviously, is in the beginning. It's kind of like, why do you hire an accountant? Do you turn your taxes to the IRS or the provincial government, or do you bring in an accountant, tax advisor to put your claim together, to put your tax return together? The same thing occurs on a claim. We always do better when we get involved in the beginning of the process. We can take control of it. Questions that the carrier or the adjuster for the carrier will ask of you, they ask of us instead. Questions that you have that you otherwise wouldn't want to ask directly to the insurance company, so they get you in trouble, you can ask of us. And we can find out exactly what's your goals, what do you want to secure, not just in the recovery, but obviously in getting up and running. And so it's always better that we get involved in the beginning. When we get involved much later, sometimes it's hard to undo the wrong that's been done. Next slide. Read the fine print of your policy. You need to understand it if you can. There are limitations in coverage and measurement issues that come into play. There's a provision in the policy called ordinary payroll, where it limits the amount of people, employees of your firm that will get paid. Sometimes ordinary payroll, you don't even have coverage for it. These would be your non-essential workers, not your key people. The key employees typically are paid for under business income coverage, but non-essential typically are not covered, or they're covered usually limited to 60 or 90 days. If you're a business owner and you want to keep all of your employees, even the non-essential ones, you want to make sure that you don't have an ordinary payroll exclusion. Co-insurance requirement, and we'll talk a little bit about that further in, is a requirement that requires you as the business owner or building owner to maintain the correct insurance for the cost to replicate the building in like kind. Inflation Guard pays for the, it allows you to increase the coverage amount that reflects what the increased costs are in a given year for construction. So for example, if your building is insured at $1 million and 6 months into the renewal of the policy, you have a fire loss, and inflation rate for construction is determined to be 10%, then your $1 million of a coverage as of the date of the loss would actually go up 5%, because you're 50% into the 12-month term of the policy. And instead you'd have $1,050,000. And you want that inflation guard, by the way, because every year your policy should go up. What I found though is that a lot of the coverages for buildings are not keeping up, even though they're supposed to, through this inflation guard that they have. So every year you should talk to a local contractor just to verify what are construction costs running, and obviously look at your building, which may be unique and may be a lot more expensive than other buildings to rebuild. You also want to look carefully to see if there's a protective safeguard endorsement. In the video with Trinity River, you heard about that. Protective safeguard endorsements are warranties that require you as an insured to maintain if it's written into the policy. Typically, we'll see a safeguard endorsement for a functioning sprinkler system or alarm system. And to the extent that they weren't working or were not properly working, the carrier can argue to deny coverage. So it's real important that you have your policy reviewed with your broker, make sure that there are no protective safeguard endorsements. And if there are, that you're complying with them every year. With Trinity River Lumber, they had a protective safeguard endorsement for the sprinkler system. And at the time of the fire, the sprinkler system went on, but the pressure was minimum, like 25% of normal. And so, of course, the insurance company made a big fuss about that. And through their investigations, and they put the insured through an examination under oath, but they ultimately found out it wasn't the insured's doing. Interesting enough, the local municipality had hired a plumbing contractor to go out and to install a special flow meter because they were concerned that Trinity River was getting more water than what was being registered. So when that company came out a week or two before the fire, they had to, of course, turn the main water line off for a half hour, 45 minutes to install the equipment. And then they turned it back on. But instead of turning it all the way back on, they only went like 30, 40%. And of course, that's what caused the problem. It got paid. The insurance carrier ended up subrogating against the third party that was responsible for not turning the water main back on completely. And our insured did get paid. Be aware that most commercial policies only insure you for actual cash value until you exercise your right to replace or repair under the policy. And in so doing, they're actually called actual cash value policies, which is based on replacement costs minus depreciation. And you need to be aware that when depreciating items, typically insurance company uses age and useful life. In Canada, similar to California, there is a provision that provides depreciation also based on use and condition, because just because an item's 10 years old and has a 20-year life doesn't mean you depreciate it 50% if the item has hardly been used. And in the instance of Trinity River, they had spare parts for every single piece of equipment because they can't afford to be shut down for more than a day or two, let alone 2 or 3 weeks, because the spare part isn't available. So for every piece of equipment, every part in it, they had every spare part for every part of a piece of equipment that would ultimately fail, they had available. The carrier initially wanted to depreciate these spare parts at 50% because some of them are 10 years old. We argued there's no depreciation, they were brand new. Ultimately, we succeeded in lowering the depreciation. The same thing applies, by the way, for pieces of equipment. You may have a piece of equipment that has a 20-year life. You only used it for 5 years. You decided to buy another piece of equipment. You set that aside. 5 years later, it gets damaged in a fire. The insurance company may want to depreciate it 50%, but it only been used 5 years out of a 20-year life. So therefore, the depreciation should only be 25%. Those are the issues that we argue, and they're the issues you should be aware of, because in Canada, it's not just based on age and useful life, it's based on use and condition. When it comes to building repairs, they are also entitled to depreciate the repairs until you rebuild the building. There is no language in Canada that talks about whether labor component of a trade should be depreciated. However, some carriers depreciate only the material components. In California, we argue that all the time because it's actual law. An example would be there's going to be different components of the building repairs that the carrier has a right to depreciate. If the roof is a 10-year-old roof and it's a 20-year life, they would normally depreciate the roof replacement 50%. When you're only depreciating the material component, which may comprise up to 40 or 50% of the cost, then the overall depreciation goes down from 50% to more like 15 or 20%. And so when addressing depreciation with the insurance company, you want to make sure that you present an argument to maybe only depreciate the material components and only those materials that depreciate. Just because your building is 50 years old doesn't mean they depreciate it 50% because they think the building only has a 100-year life. Buildings can last 200 or 300 years. Foundations, they don't depreciate much. Framing doesn't depreciate much. So it's important to have discussions when you do have a loss to let the carrier know about what should be depreciated and what shouldn't. Policies in Canada have a suit time requirement of 2 years from the date of loss. What that means is if there's an issue of coverage, if they're still investigating coverage and they don't think a portion of your claim is covered under the policy and you're getting near that 2-year time frame, you want to make sure that you retain counsel and file a suit so that you're protected in case the claim goes to litigation. Definition of a named insured. You want to be careful in making sure that the named insured in the policy is not just for the business if you also own the building. Many times businesses, they own the building as well, but instead of the building being in the name of the business, it's in the name of an LLC or in the name of the husband and wife that own the business. If the building is named under the wife and husband or under an LLC, then obviously you want to make sure that's also listed as an additional insured under the policy. If it's not, then you want to, and there isn't building coverage, and obviously you want to also make sure that the building coverage a policy is issued under the name of the husband and wife. Subrogation. Subrogation is what the carrier is entitled to secure if it's deemed that there is a third party at fault. But if you as a business owner have excess losses, for example, let's say the carrier pays you $900,000 for your losses, but you have $100,000 of losses that are not covered, then you in Canada have the right to pursue on a prorated basis with the carrier for your excess losses. So if the carrier ends up securing a $500,000 recovery for what they paid out to you, you would be entitled to 1/10 of that $500,000 recovery. Next slide, please. Coinsurance. Coinsurance is not your friend. Coinsurance is a requirement that requires you to insure the building to value. A lot of times business owners or building owners think that they don't really need to insure the whole building. For example, you've got a 10,000 square foot building and it's a concrete building and the building is divided in half with a fireproof concrete wall. Well, obviously, if a fire ensues in one area of the building owner is pretty sure and comfortable that only 50% of the building is going to get damaged. And so he insures the building for $2 million, he insures it for $1 million. Well, the carrier wants to make sure that if you're taking out a policy of insurance, that you're insuring 100% of the replacement value of that building. And to the extent that you're not, you will become a co-insurer in the loss. You will share on that loss. In the example of 100% co-insurance and you have a $200,000 repair, you're only going to collect 50%. If you have an 80% co-insurance requirement out of $200,000 loss, you're only going to collect roughly 63%. So you want to make sure that you insure to the full replacement value. Next slide, please. So obviously, to avoid co-insurance, you make sure you insure to full value. Some of the commercial policies in Canada provide a waiver of the co-insurance requirement if you provide a statement of values yearly prior to the renewal of the policy, and that they are then reviewed by the carrier. And if the carrier accepts them, then the co-insurance requirement is typically waived. There are other ways to at least minimize the co-insurance penalty. Obviously, one by increasing the loss and lowering the value of the undamaged portions of the building or business personal property. I've got a loss that I've been handling in Salinas, California. It's a wax paper company, and they are horribly underinsured. They have plenty of coverage, but with respect to co-insurance, they were valuing their buildings at roughly 25-30% of the replacement costs. Carrier wants to make a co-insurance penalty of roughly 75%. We made an argument that the buildings may be properly insured on an actual cash value basis. At the time when this policy was issued, actual cash value on total losses is market value, and the values that were listed were slightly below the market value of the buildings. But what it allowed us to do is to make a strong argument to lower the co-insurance penalty dramatically. Any questions come up?
Let's see, one says, how do you deal with medical claims or do you deal with medical claims or other types of insurance problems?
If you heard, the question deals with medical claims. Just so you know, we typically don't get involved on any type of claim other than a property claim. We're only licensed to handle first-party property losses.
And there are a couple of others, but you want to finish because we're close to
Sure. Let's go ahead. The next slide, please. What do you do to help mitigate your exposure? What should you be doing every year? Obviously, you want to meet with your broker. You want to make sure that you have proper replacement values for your building, your stock, your equipment. Let the broker know of any major purchases you've made. Provide them with the yearly sales revenue. That's really important, because if your business is growing, you don't want him using the sales revenues that you provided to him 5 years ago and having that as your in calculating the gross profit and the coverage amount for loss of income. Obviously, call your agent when you make a major purchase right away of an asset. Have your in the cloud, including all of the receipts for major purchases. Perform a yearly or quarterly physical inventories of your stock so it's current. Photograph the property yearly, save it to the cloud. Next slide. I think that's, lastly, with Trinity River, like any loss claim that we're handling, it's not just a matter of maximizing the settlement. It's about allowing the business owner to do what they do best, which is running their business, and obviously expediting settlement. This slide provides our monthly flyers and newsletter that we send out. We'll have some interesting topics on coverages. Feel free to pass your email information and address, and we'd be more than happy to put you on our mailing list. I'm also available anytime to answer questions. If you've got some policy renewals coming up and you want to get some feedback on your coverages, feel free to reach out to me. There'll be a slide with my contact information.
And then there are a couple more questions that
Sure.
came in if you want to take them really quickly. One says, why can't I just use my lawyer if I have a problem?
Lawyers in the States, at least in California, can adjust claims. I'm assuming in Canada they can as well. Most lawyers that know of us typically recommend to their clients to use us. You don't want to be paying a lawyer $800 an hour to inventory all of your belongings that were destroyed in your home or in your commercial business. We have in-house inventory staff, in-house building consultants gather those claims. We have an in-house forensic accounting department as well. Attorneys aren't geared to doing that type of work. And most attorneys, when they have losses that know about us, will typically reach out to us directly. It's a burdensome task, and typically we secure very, very favorable results when we get involved, because this is what we do for a living. Most attorneys don't do this for a living.
And then the last question, I think you probably answered, but it says my agent is a good friend. Can he help me through a claim?
Look, agents are good to have if you do run into a problem, but all they're going to be able to do is to call the adjuster and say, hey, my client's upset. Why aren't you paying for this or paying for that? In California, in fact, agents are not even licensed and can't do what we do. Most agents are not going to have the personnel to complete a detailed inventory of all the property that was destroyed, to address the cost to replicate the building. They don't have in-house forensic accountants. And a lot of times the adjusters, they'll listen to the agent, but the adjuster answers to his principal, which is his boss at the insurance company. When we get involved, we answer to you, the insured, and we present the claim to the insurance company adjuster. That's it.